This is the Clear Money Talk podcast, offering up creative solutions for your retirement future through education, choice, transparency, and empathy. Now, your host, CEO and founder of Clear Financial Partners, Tim Claremont.
Hello and welcome. Welcome to Clear Money Talk. My name is Tim Claremont, and I'm here with my co-host and excellent partner in crime here, Tyler Andrews. Tyler, say hello to the audience.
Hello, audience. Tyler Andrews on the mic. Check 1 2.
Yeah, it's always nice when he actually does what I ask him to do, isn't it? It's like, hey, say hello to the audience, and he says hello to the audience. That's great.
I can't name a time I didn't do something you asked me to do, Tim.
That's fair. I appreciate that, Tyler.
Just don't ever ask me to jump off a bridge.
I will not ask you to jump unless we're going to bungee, because if we're going to bungee off a bridge, that would be pretty fun.
That would be pretty cool.
Have not done that yet. That's definitely. I do enjoy that sinking feeling. You know, I love roller coasters. For those of you that have been listening for a while, you might have heard me mention that in the past. I enjoy the roller coasters. Though I will say that I appreciate roller coasters when it relates to investment portfolios, much more when they go up and when we have safety nets on the way down, which is. It's kind of the way we roll with a lot of the things that we go with as far as investments are concerned. Today, we are answering the question, what is a L.I.R.P? And you may have seen that question and been like, man, I have no idea what a L.I.R.P is, but maybe I just kind of want to hear Tim and Tyler talk again. And that's okay. So I'm glad you're listening. Let's talk about what a L.I.R.P is. And if you've heard of a L.I.R.P before, L.I.R.P, it's an acronym, and it stands for something called a Life Insurance Retirement Plan. And a lot of different people out there will use life insurance for all kinds of different purposes. If you are thinking that maybe you already have a L.I.R.P, maybe you're considering getting a L.I.R.P, maybe you've heard of this terminology before, that's what's making you listen to this. But we'll talk about it, and it's certainly got some pros and some cons, and some of those aspects people use it very often for helping generate additional income in retirement with certain tax benefits. We'll talk a little bit more about that today. So. Tyler, anything else you want to share on the general concept of L.I.R.P? What are your feelings about things, that kind of stuff?
I mean, we could share a lot. This is a meaty topic, if you will, and I think having a foundation of what life insurance is crucial to know this. I don't know if we've done a podcast on what is life insurance in the past. We may have.
Yeah, it's actually a good topic to consider, maybe. I know we've talked about life insurance. How do I know how much I have? We've talked about that, I think, in the past. What's the right amount? What's the right type? I remember discussing that. But specifically focusing on a L.I.R.P today, people use life insurance in this way to generate supplemental retirement income down the road. And one of the nice benefits about many life insurance policies, basically, you have two kinds of life insurance. You have temporary insurance and you have permanent insurance. Temporary insurance is probably what a lot of us are familiar with. That's your term insurance. Term insurance is just like renting. When you rent an apartment or you rent a home, at the end of your lease, you're going to get evicted. At the end of your term with term life insurance, you're going to get evicted. You have no more life insurance coverage. If you die during the lease, then you get paid, your heirs get paid. And if you live past the lease, you're no longer in the home. So you no longer have money being paid to your heirs. Permanent insurance is the alternative to that. And all permanent insurance has cash value inside. People invest extra money. They pay more than just term insurance. They put extra money into this bucket, and that extra bucket is referred to as your cash value. Your cash value continues to be in the account and grow over the years. And then later on, it sustains your policy in your later years, your 70s, your 80s, your 90s. Many times the policies are designed to allow you to make level contributions, even though the cost of insurance is clearly higher in your 70s, 80s, and 90s, because your risk of death is higher. Than it would be in your 20s and 30s and 40s. And so the cash value was a way that insurance companies created this ability to pay a level premium throughout your entire life for a certain amount of life insurance and allow you to overpay in the early years and then underpay in the later years so that you know that your beneficiaries will still get that death benefit later on. And that's really fundamentally what permanent life insurance is. The original permanent life insurance, you're talking about whole life. Well, since then, things have been modified significantly with that cash value, because that cash value can be invested, right? While it's sitting there waiting to cover your cost of insurance in your 70s, 80s, and 90s, and you're putting it in your 20s and 30s and 40s and 50s, you can actually have that money growing. And there's different ways to grow it. You can grow it in the stock market through variable universal life insurance policies. You can grow it in a CD-like way through your traditional whole life policies or your universal life policies. or you can do something kind of as a hybrid in between, which is what we often use, indexed universal life policies, where you have that safety net on the roller coaster we were talking about earlier, where when the market goes down, you don't go down, but you still get the upside of the market, just not as much upside as a variable life policy, for example. So how does all that play into creating retirement income? You're probably sitting here thinking, life insurance, that's a death benefit. If I die, my heirs get some money. How does that help me in retirement? So for those of you that are thinking that, let's take it one step further. So a L.I.R.P is just when you have that cash value in that life insurance policy and you say, you know what? I can actually access that while I'm alive. What if I dip into that cash value before I die and I use some of that money? And the idea behind using that money is well, I can withdraw it, and that's fine. But also, what if I just borrow against it? And that's where it gets interesting. So when you borrow against your cash value, a loan is, under current law, not taxable. And with life insurance policies, as long as they're not turned into what's called a modified endowment contract, they also are not taxable. You can borrow against the cash value and have that loan come out tax-free. Well, and you might think, well, what good is that to me? If I borrow against it and it's a loan, I still got to pay it back. Sure, you're right. You got to pay it back. But you don't have to pay it back until you die. So you can actually pay it back out of the death benefit when you die. And the death benefit's also protected and tax-free. So imagine if you take a loan out with tax-free money each year for a little while, and then when you die, the death benefit's tax-free to you and your heirs. Your heirs pay off the loan with the death benefit money tax-free, and then the leftover death benefit goes to your heirs tax-free. So that's the cool concept of really how a L.I.R.P came into play. It's just different ways of saying, hey, what if our focus is shoving as much money into this cash value as we can so we can borrow against it over a period of time, and then we'll pay the loan off when we die from that death benefit. And the concept of creating this supplemental tax-free income stream in this way was simply referred to by the acronym L.I.R.P, Life Insurance Retirement Plan. And that's what that means. So if you Google what's a L.I.R.P, you're going to get a short answer, something along these lines, but at least you'll have a better understanding of how it works today. And I think Tyler and I will probably go through a few examples of how we use this with our clients, because it's just like any other tool. You could say, what is a 401k? You can learn the basics of a 401k. You can say, what is an IRA? You learn the basics. But until you figure out how to use that tool, it's just a concept. And we'll talk a little bit about how we use L.I.R.Ps. Anything you want to add to that, Tyler?
I think if I was a listener right now and just learning what a L.I.R.P is, I would want to know, well, how do I build one of these L.I.R.Ps, Tim? I know how to save in my 401k. It comes out of my paycheck. I know how to save into my IRA. I just send a check in once a year and it gets invested into my IRA or Roth, as an example. But if I want to set up a L.I.R.P, what do I got to do? I have a term life insurance policy, right? It's a X death benefit size, and that's great because if anything happens to me, that'll take care of my family and kids and dependents. But with a L.I.R.P, do I do the same thing? Do I try to get a huge death benefit on there, or do I try to get a little death benefit as possible and shovel as much money as possible in there, which is kind of the opposite of what you want to do with what people typically think about life insurance, right? You try to get the biggest death benefit that you can afford for the lowest premium, but with L.I.R.Ps, it's the exact opposite. We're trying to do the smallest death benefit with the most amount of money you can put in there for that level of death benefit. And it's a different concept.
Yeah, no, you're spot on, Tyler. And how do you get one of these going? How does that work? And how do we structure it? So I think we can answer that. And you're absolutely correct in terms of that thought process is very different when it comes to a L.I.R.P. They're really the quick answer. How do you get one? Well, you qualify physically. You talk to an insurance agent who's licensed to work with insurance policies, and you acquire the policy. You start making payments. You can pay annually. You can pay one time up front, and have the insurance company kind of feed it in over time. You can pay monthly as far as regular contributions. You can pay erratically as long as you cover the minimum amount. You can maybe put extra money in later on as well when you come into extra money. So there are a lot of flexible ways to make the contributions. It doesn't just come out of your paycheck, though. It typically will come out of your checking account with after-tax money that you've already paid taxes on and you have set aside. So that's the quick how. And of course, you do have to qualify physically. You can't buy life insurance without being healthy. So if you don't qualify for a life insurance policy, this option is off the table. You're going to have to look at other choices. So this isn't the kind of thing you go out and get when all of a sudden you find out you're sick. That's unfortunate. At that point you're like, oh man, I really wish I could have this now. Well, it's too late. You have to get it before you're sick, when you're healthy and you can qualify for it, and then you can use this kind of a tool. in your toolbox. So a lot of, it's sad, but a lot of the people that are healthy are thinking, hey, I don't even want to think about life insurance. I'm healthy. Nothing's going to happen to me. And then they get sick or get in an accident or something bad's happening and things don't look so good. And they're like, oh man, I could really use some life insurance. And well, it may be too late. You can't get it anymore because something bad happened to you. So you have to get it while you're healthy. As far as the how to get it. So that's something that, is important to point out. Yeah. But you touched on another concept here too. Life insurance can be used in two really fundamentally different ways. One is, how do I get the most death benefit possible for the lowest possible price? And that's where term insurance is probably the cheapest for a short period of time. It's pretty inexpensive. Or you can have a permanent policy for the lowest possible price. That's not what you're doing with a L.I.R.P. L.I.R.P is on the other end of the spectrum. A L.I.R.P is saying, hey, I want as much money for me as possible while I'm alive. I want the lowest cost of insurance possible, and I want to use that tax-deferred investment vehicle of the cash value bucket to shovel as much money in as I can. In that scenario, you want to have the lowest death benefit possible. But see, they used to have no real limits on these kinds of policies. Back in 1986, when the variable life policy really kind of came out, there were no limits on these policies. So all these very wealthy people would buy this little $25,000 life insurance policy and flood it with thousands and millions of dollars in cash value. They'd build this huge cash value bucket, have it grow tax deferred, borrow against it tax free. How cool was that? Well, 1987, Congress closed that loophole and they created what are called the TAMRA-TEFRA guidelines. And TAMRA is just an acronym, as is TEFRA for a law. TAMRA and TEFRA, and those two laws control how much you're allowed to contribute to life insurance policies. So your goal is to say, how much do I want to save each year into this thing to build up that bucket of this additional retirement plan, and then you back into how much insurance do I have to allow me to put that much money into it. So your focus is the lowest amount of insurance that you need to have in order to allow you to take advantage of the cash value investment with the tax nature associated with it. And then you can make some adjustments to it. You might actually start at one level of insurance, and then down the road, after 7 years, that TAMRA rule falls off, the TEFRA still applies, and you can actually shrink wrap your policy and do a face decrease, dropping your death benefit down, keeping your costs even lower and allowing more cash value accumulation with less drag on the cost of life insurance. So it's a more complex way of using life insurance, really a life insurance retirement plan like this, but yet a very common way. A lot of people use it all the time. Once you max out your 401ks and your IRAs and the traditional stuff, you still got more money you want to save for creating a supplemental income stream in retirement, and you want a tax-free income in retirement. This can be an excellent tool to add to your overall retirement plan.
Absolutely. Yeah, I think that's a good point you hit on right at the end there, Tim, is that a lot of people who look to this concept are already doing some of the, I guess you can say, more traditional types of investing, the 401ks, the employer-sponsored retirement plans, the IRAs, the maybe non-qualified brokerage accounts. They already have adequate emergency savings at the bank, doing all the traditional stuff, if you will. And they still say, I still have more income I want to save, guys. There's a delta between what I'm saving and what I want to be saving, or what my projected retirement income is right now versus what I want it to be. And this is often the next best thing to look at is a L.I.R.P. If it works for you. Everyone's different though. Some people, it's a perfect strategy. Other people, they want to look elsewhere. Nothing wrong with that.
Yeah, no, you got to look at all the different choices that are out there. A lot of times we try to make things simple when we're working with our clients. I mean, retirement income planning is the primary thing we do here at Clear Financial Partners. And, I find that one of the easy ways to articulate retirement income planning is just to put things in buckets. Talk about, here's this type of strategy. And we categorize these buckets with a color because it makes it easier for us to understand when we're having a conversation with a client. So, there are probably 4 main buckets that we talk about with clients all the time, and I've assigned these colors to them, blue, red, yellow, and green. Blue is your typical managed money portfolio. It's invested in stocks, bonds, mutual funds, all that kind of stuff. No guarantees on it. It goes up and down, and we just do a best job we can to manage it. A lot of people have that kind of bucket out there. A red bucket is what's called a fixed indexed annuity. It's an insurance company product that gives you a guaranteed income stream for life. There's no way to lose your money on the downside, and there's typically no fees in the account. They usually come with a surrender charge. You don't make as much on the upside, but knowing that they're not going down is hugely reassuring. So it's a conservative way of producing what can be a very significant retirement income stream for individuals. Then you have yellow, which is sort of a hybrid of the blue and the red. That's your variable annuities, and those can go in the stock market. They go up and down in the stock market, but you can attach insurance to them that produces an additional income stream guarantee for life. and that's typical with yellow. Those three vehicles, we've talked previously about them. If you listen to our other podcasts, you can go into more detail about variable annuities, fixed indexed annuities, managed money, and all that. But the green bucket is the one we're talking about today. Green is a life insurance retirement plan bucket, and you don't use your pre-tax retirement money. You don't use your 401k money, your traditional IRA money, or even your Roth 401ks or Roth IRA money to fuel this. At least not directly. You have to get the money out of those kinds of accounts, have after-tax money, and then you put it in this green bucket, which is a life insurance retirement plan. And the neat thing about it, if it's done correctly, is it can produce another tax-free income stream for you in your retirement. How cool is it if you retire on, a couple $100,000 a year, and maybe 100 of it's taxable legally, and the other 100's not legally? That's pretty cool. So it drops your tax burden down the road, and a lot of people use these kinds of life insurance retirement plans to produce that extra tax-free bump in income down the road. Many people actually use it as a cost of living adjustment strategy, where they'll set the extra money aside and just pull that lever when they need that cost of living adjustment to battle inflation and have that extra income come out of the green bucket and have it be tax-free at the same time. So it's a nice strategy we implement all the time with clients. So that is the quick or not so quick answer to what is a L.I.R.P. The quick answer for those people that are hitting the just the answer button: a L.I.R.P. is a life insurance retirement plan. It is a green bucket, if you will, a tax-free income source in retirement, and you have to qualify for it as a life insurance policy. We're overfunding a life insurance policy with a minimum death benefit and trying to produce tax-free income later by borrowing against it and then letting the death benefit pay off that loan when you die with income tax-free dollars. That's your quick answer as to what is a L.I.R.P. But I do think there's a lot more meat to unpack. So if you just listen to the quick answer, you should probably go back and listen to the longer answer if you like that concept, or if you like tax-free income. So
I don't know why you wouldn't like either of those things. Tax-free income sounds good. Life insurance sounds good.
It is. It's like, would you like pizza or pizza? I mean, clearly I like pizza. So
yeah, I'll take the pizza.
Yeah, right.
No pineapple though.
No, I respect that. I respect that, actually.
Yeah,
I will. It's funny. I mean, total side point, but yeah, man, now you got me hungry. I'm thinking about Nona Amelia's pizza. I absolutely love Nona Amelia's pizza out there in Aloha. That's like this thick crust pizza, and it's got such good toppings on it. Pepperoni, that's a Sarah's is my favorite. Add the jalapenos, the pepperoni, and it's got pineapple on it, which I don't normally do pineapple like that. But when you put pineapples and jalapenos together, something happens with that sweet and spicy. This kind of a magical thing. So,
Tim might be drooling right now.
Little bit. It's happening. It's happening.
Anything else that we should add on L.I.R.Ps? I think that's something that people want to look to see if it makes sense for them. They give us a call, 503-579-1000. We're experts in L.I.R.Ps and life insurance in general, so we're happy to talk about that stuff. If you don't want to call us, that's cool too.
We're not going to take it personally.
No.
We're just wounded, like in our soul.
Yeah.
We're feeling the pressure of the night. Thank you very much for not calling us. I feel so bad now. No,
tail between our legs. Call somebody that you can trust, though, if you want to talk about this stuff. Just make sure that you're teaming up with somebody that knows what they're talking about when it comes to this strategy, or any strategy for that matter, and that you feel good about that relationship. But yeah.
Cool.
I feel good with that.
Yeah. No, I think that's great. I think that's a good answer for today. We understand what L.I.R.Ps are.
Yeah.
There's lots more books out there that you can learn about L.I.R.Ps if you want to, check all that stuff out. One of the good books that's out there that I've read is Look Before You L.I.R.P, which is by David McKnight, and he's also written The Power of Zero for those of you anti-tax people out there that want to try to keep your taxes at the absolute zero level. The Power of Zero is there for you to talk about. There are a couple of short books that I actually really appreciate a lot of the insights that are in there. So it's more information for you to keep learning. But if you need somebody to help you get one of these or help you implement one of these, just give us a call. That's what we do. So happy to help you out. Right. Let's transition to the fun part, right? Oh, not that you weren't already having fun. It was pretty fun. You're right. So our fun part for today is our trivia. So stump the nerd. We should probably call it Stump the Nerd. That's what Tyler's going to do. He's going to try to stump the nerd.
Well, in the spirit of Halloween, we're recording this in October right now. We're going to have a somewhat spooky themed trivia question. Someone's going to hear that, and they're going to hear the question and be like, Tyler, that's not spooky at all. You suck, et cetera, and so forth. But
it's okay. We can take it. Our ego's strong enough. We're working on it. It's fine. A little bit. Actually, we really can't take it. Don't tell us that it's not. No, go ahead, Tyler.
All right, trivia question of the day. What is the name of Jack Skellington's dog?
Oh.
Do you need to know the movie?
Yes, I got it. I got it.
Yeah.
No, I think I know. It was Zero.
It was
believe.
Zero.
Zero. That's right. I remember
That was too easy for
that
you.
little floating dog. Well, I don't know why I
Ghost
remember
dog.
that. I think I saw that The Nightmare Before Christmas. I think I saw that once.
That's right.
So it was, that was really solid. You know, some weird things just stick in your head, and just seeing that little floating dog by those skeletal creatures that Tim Burton drew. I just remember
That
its
stuck
name
with
Zero. It did. It did. I'm not much for scary movies. Crystal loves scary movies.
She does.
And she'll, every now and then, if I want to give her a present, a gift, I will watch a scary movie with her, because I do not enjoy scary movies.
No, you don't.
About as scary as I like is Nightmare Before Christmas, Tim
That's
Burton.
fair.
That's
fair.
about as scary as I want to get. I will never forget some of the other more horrific scary movies that have been implanted in my brain for all eternity, and I do not have any more room for more of them, so I would rather not see any of those ever again. But we'll see. It is what it is. The things we do for the ones we love.
That's right. We all have our limits, and it's good to know those limits.
That's right. Well, until next time, I think that'll bring us to a close for today. So
Sounds good to
Thank
me.
you for listening. Thank you for giving us your minutes. And we truly do look forward to hopefully an opportunity to hear from you at some point down the road. And if you learned something smart about money today, please go to somethingsmartaboutmoney.com. You don't have to become a client or reach out to us, though we would like that, of course. But at a minimum, if you learn something smart about money, we're trying to teach 1 billion people something smart about money on this planet, and we are counting slowly, one person at a time. Go to somethingsmartaboutmoney.com and get counted. Just say, yes, you taught me something smart about money today. I'm going to acknowledge that. That's like our own little way of feeling like somebody out there somewhere is listening.
You're out there. I know you're listening. And thanks for tuning in, guys.
Until next time.
Investment advisory services are offered through L.I.R.P Advisors, LLC, or registered investment advisor. Securities are offered through L.I.R.P Securities, LLC, member of FINRA IPC. Exposure to ideas and financial vehicles discussed should not be considered investment advice or a recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments may fluctuate, and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Timothy Claremont is licensed in your state, please contact his office. L.I.R.P Advisors, L.I.R.P Securities, and L.I.R.P Life LLC are not affiliated with nor endorsed by the Social Security Administration or any other government agency, and does not provide tax and/or legal advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through L.I.R.P LLC NPN number 194283777 and or L.I.R.P Securities NPN number 197499604. Any discussion of general investing strategies or specific securities are for conversational purposes only and should not be taken as a guaranteed endorsement or recommendation.